When people talk about downsizing, they usually talk about the sale price, the smaller home, and how much money will be left over. What they rarely talk about is what the money could do to your age pension. Your family home is generally excluded from Centrelink's assets test, but once you sell, the proceeds may be treated differently. Some may qualify for a temporary exemption, some may become assessable, and even exempt proceeds may still affect the income test through deeming. This is the money side of downsizing that many retirees only discover after the decision has already been made. In this video, I'm going to explain the two parts of the sale proceeds that Centrelink may treat differently, the questions to ask before listing, and why simply putting the money into superannuation may not solve the problem. This is general information only. Your unique position will depend on your income, your assets, superannuation, and the relationship status and your future housing plans. Now, let's start with the rule that causes much of the confusion. Your principal home is generally excluded from Centrelink's asset test. That means a couple could live in a valuable Mornington Peninsula home and still receive an age pension, provided their other income and assessable assets remain within the relevant limits. For many retirees, this has been the position for decades. They may not have had to think closely about the value of their home because Centrelink has generally not counted it. But once the property is sold, you no longer have one exempt home sitting on a block of land. You have money. Centrelink then needs to determine how much of that money is intended for your next home and how much will remain available for other purposes. That distinction is extremely important. Imagine you sell your home for $1.4 million. You expect to spend $900,000 on your next home and approximately $70,000 on the selling, purchasing and moving costs. Now that could leave around $430,000. Centrelink may not treat the entire $1.4 million in exactly the same way. The amount genuinely intended to buy, build, rebuild, repair or renovate your next principal home may be exempt from the assets test for up to 24 months. In some circumstances, a further extension of up to 12 months may be available. However, the remaining money that is not intended for the new home may be added to your assessable assets. And that could include your existing bank accounts, your term deposits, shares, vehicles, investments, and assessable superannuation. So the important number is not simply your selling price. It is how much you will have left after buying, selling, and moving, and what your total assessable position will be after that. The income test can still apply. There is another point that is easy to miss. Even when qualifying sale proceeds are temporarily exempt from the assets test, Centrelink may still treat the money as earning income. This is called deeming. For qualifying home sale proceeds, the lower deeming rate applies during the exemption period. As at the 1st of July 2026, that lower rate is 1.25%. So exempt from the assets test does not mean completely ignored by Centrelink. Centrelink applies both an assets test and an income test and generally uses whichever produces the lower pension payment. This is why two couples who sell for the same amount could receive very different outcomes. One may already have substantial superannuation and investments. The other may have had very few assets apart from the family home. Their sale prices might be identical, but their Centrelink outcomes may be completely different. The temporary exemption and deeming treatment are explained in the attached guide, which is a free download. Services Australia confirms that qualifying proceeds intended for another principal home are deemed at the lower rate, while additional proceeds are assessed at the ordinary deeming rates. As I mentioned, we've put the important questions and current thresholds in our free guide, Downsizing, Centrelink and your pension. It includes questions to take to a financial advisor, information about selling before buying, granny flat arrangements, and the records you may need to keep. So download in the link below. Now, let's look at the part that could affect your ongoing pension after you have moved. Once you buy your next home, that new principal residence will generally become exempt. But any money remaining outside the home may form part of your assessable assets. From July 1st, 2026, a homeowner couple can generally have a combined assessable assets of up to $499,000 before the assets test begins reducing their pension. The assets test cutoff for a homeowner couple is generally $1,102,500, although the income test and individual circumstances must also be considered. These are combined limits for the couple, not $499,000 each. So, suppose your move leaves you with $430,000. That amount alone does not necessarily mean your pension will be reduced. Centrelink will also consider the assessable assets you already had before selling. If you had another $200,000 in bank accounts, superannuation, vehicles and investments, your combined assessable assets would then be around $630,000, and that is the calculation that matters. The guide records the homeowner couple thresholds applying from the 1st of July 2026 and notes that the income test must be applied. The official part pension cutoff for a homeowner couple is $1,102,500 from that date. A common assumption is, we'll put the extra money into superannuation so Centrelink won't count it. For someone who has reached aged pension age, superannuation is generally included in the assets test and may also be subject to deeming. Eligible people aged 55 or over may be able to contribute up to $300,000 each from the sale of an eligible home into superannuation. That may provide taxation or retirement planning advantages, but it does not automatically protect age pension eligibility. A downsizer contribution should therefore be considered as part of an overall retirement strategy, not as a way of making the money disappear from Centrelink. The guide specifically cautions that placing proceeds into super does not necessarily protect age pension eligibility once someone has reached pension age. Selling first can give you certainty about your budget. It may also mean you need temporary accommodation while you're looking for the smaller home. Before choosing that strategy, ask yourself, how much of the proceeds will be needed for the new home? How long might it realistically take to buy that new home? Will you rent temporarily? How could renting affect your homeowner status or rent assistance? What evidence should you retain showing the amount intended for your next home? And importantly, when should Centrelink be notified? The exemption period generally begins at settlement, not when the property is first advertised or when the contract is signed. Do not assume Centrelink will automatically know how much of the money is intended for your next home. Tell them about your sale and your plans. Those planning questions, including the settlement date starting point, appear in the guide. Some people do not intend to purchase another property in their own name. They may build a unit on an adult child's property, contribute towards a shared home, or pay for a lifetime right to live with family. Centrelink may regard this as a granny flat interest, even when there is no separate granny flat building. These arrangements need careful legal and financial advice. Centrelink considers what you paid, what you've received in return, whether you have a lifetime right to live there, whose name is on the title, and whether any part of the payment may be treated as a gift. A family understanding and a Centrelink recognised arrangement are not necessarily the same thing. It is important to have the arrangement documented and to consider what happens if the property is sold, the adult child divorces, someone dies, the relationship breaks down, or you later need aged care. You do not need to become a Centrelink expert before downsizing, but you should do two things. First, obtain a realistic estimate of what your current home may sell for, what the next home is likely to cost, your selling, stamp duty and moving expenses, and the likely amount remaining afterward. Second, take those figures to someone qualified to assess your individual position. Services Australia's Financial Information Service is free and can explain how the rules operate. You may also need advice from a licensed financial advisor, accountant and solicitor. Ask for the calculations and advice in writing wherever possible. The guide recommends obtaining a selling estimate, preparing a full list of income and assets, confirming the next home budget, consulting the Financial Information Service, and obtaining advice before deciding on sale timing. The money nobody talks about is not simply what you made from the sale. It is how the sale changes what Centrelink sees and what remains after the move, and how those funds may affect your retirement income. For many people, downsizing remains a sensible and positive decision. The message is that downsizing is not only a property transaction. It may change your assessable assets, deemed income, homeowner status, retirement cash flow, and possibly your future aged care position. The best time to understand those changes is before your home is listed, not after the money reaches your bank account. Download our free Downsizing Centrelink and Your Pension Guide using the link below. And for your next video, watch Financial Planning for Downsizers, What You Need to Know, where we look at the broader costs and numbers involved in planning your move.